in my view, is Maruti and Tata Motors. Bad news is just not getting reflected out there. In fact, look at how Kotak Bank, one of the laggards of the banking space, has also come back, gaining cool 3-4%. Today, we are discussing markets and much more with the NJ Mutual Funds, Rajiv Shastri, joining us on the show. Rajiv, very good afternoon. Thanks so much for your time. NJ is a name which is synonymous with retail investors. And of course, retail investors have shown their faith in the markets in a big fashion. The SIP figures crossing, almost nudging the 10,400 mark last week. Before we talk specifically markets, at NJ, you guys work across the length and breadth of the country with investors. What is really leading to such strong faith about equities among investors? What's the feedback?
Thank you very much for having me here, Ajay. And, it's an honor to be here talking to you. It's a cycle that we've seen many times, and this happens every time the markets, do well. Investors typically are attracted by markets that do well and do, tend to participate in much larger numbers, at times like this. And this is a phenomenon across the country. Now, combined with the fact that, the economy is doing extremely well as well. There's people who have surpluses, people who have, who have savings. Also, coupled with the fact that fixed deposit rates are at all-time lows, I think that's what's causing a, unprecedented interest in the market right now. And that's not just supporting the market, it's supporting, investor behavior as well.
And you are one of the newest entrants, though you are a veteran of the market, but the company is one of the new entrants in the mutual fund space, NJ AMC. How is it? How are you testing the waters? One more AMC got listed today, Birlas. You've been an industry watcher for a long time. What's the business case to build and operate in the Indian market as a new AMC? How are you guys trying to differentiate yourself?
Okay, so I mean, this is a very, very good time for us. Very proud moment for the NJ Group and for NJ Asset Management as well. Because we launched our first NFO on Friday, which is the 8th of October. It closes on the 22nd of October, so that's the NFO period. And we've been working in the asset management space for more than 10 years now as a portfolio manager, and we are today among the largest portfolio managers in the country. We wanted to develop our products, and we operate on a rule-based investment philosophy, which is very, very different from what is available in the markets currently. Whether it's asset allocation or stock selection or assigning weightages to stocks, we operate on a very, very different philosophy where we do all of this based on rules which are pre-decided. This approach eliminates human bias and tends to build a portfolio that is very, very different from that of the other form of investing, which is typically human beings taking decisions.
Sure.
So there is a clear differentiator that we have in mind when we entered this space, and it's a, like I said, a proud moment for us to be able to launch our first product, which is the NJ Balanced Advantage Fund. We felt that the Balanced Advantage Fund was very appropriate for this time of the market, where people are, in equal measures enthusiastic as well as, a bit concerned about where the markets are headed. So we felt that this product was a very, very good one. Now, coming to the long-term business case, I mean, I've said this very often. The mutual fund industry today is where banks were in 1970. We touch about 1.5-2% of the population, and our AUM is about 15% of GDP. In the 50 years that have passed since, bank deposits have grown to 75% of GDP, and and that's just not it, because that's just a five times multiple. But GDP itself has grown more than 300 times. So the scale of growth that the banking industry has experienced from 1970 to now is what I believe lies, in the future of the mutual fund industry. So the question now isn't exactly as if, that is there enough space for new entrants? I think there's space for not just us, but for many, many more entrants. I think the key would be in offering clearly differentiated products that provide diversification opportunities to people's portfolios, as well as a way of investing that is markedly different from what is existing today. Because there are many fund houses doing a wonderful job of managing money, through the discretionary active approach. And new entrants, I think, will need to differentiate themselves a little bit. But the opportunity is there. The opportunity is at a magnitude that we can't even begin to imagine right now.
Rajiv, what are your models telling you? The research team, your quant, guys, what are they telling you about valuations versus earnings growth and the attractiveness of the market metrics? If you could give some insights from the data which you're reading out of your models.
Correct. So like I said, we follow a completely data-based approach. So we look at market, equity valuations, and not just valuations, the final allocation that we make to equity. We look at it from various perspectives. So it's not just about market valuations; it's relative valuation compared to what the valuation of the history of that valuation has been over a period of time. We calculate an equity risk premium, which we use to project profit growth in the future. So there are multiple ways in which we look at it. As things stand, the composite outcome of all of these, methods that we're utilizing is an equity allocation of roughly 40%. This is a combination of a variety of factors. So we take into account liquidity, we take into account a lot of other things. So a combined, the combined output of all of this is an equity allocation of over 40%, which is, as you would understand, it's kind of a midway path. Taking a midway path between being bullish and being worried. So that's what the indication is from our calculation.
Very quickly, Rajiv, if you could tell us over the next 12 months, what's the focus now that you're leading this business? You just launched your new fund offer, balanced one. And as I know, NJ for several years, right from the founders and other senior colleagues, it's a conservative house. It focuses on processes. It works very closely on ground with the investor community. And so what's your focus area after this balanced advantage actually kicks off and connects distributable money? What's the next area to work on?
Our approach to the business is that we won't be doing, many NFOs. We're not going to be a NFO heavy, participant. What we are doing is probably launching a couple of flagships. Maybe, one would be this balanced advantage category. Next, when the time is appropriate, we already have approval for a 100% equity fund, which is a flexi cap fund. So we'll be looking at launching that sometime in the next 1 year or so. Like I said, we are not going to be a NFO launch heavy fund house. Our focus will be on launching, funds in categories that we consider to be our flagship categories. And managing that money to the best of our ability, to the best of our capabilities, and growing those funds, in size, rather than going out and launching new and new products.
Best wishes to you and everybody at NJ and NJMC. Thanks very much for your time, and also best wishes for the Balanced Advantage Fund, the debut one.